So, welcome back to this Talk Tickers Deep Dive.
Glad to be here, as always.
Yeah, it's great to have you. For you, the listener, our mission today is really to just slice straight through the corporate jargon of Assurant Incorporated's Q2 2026 earnings call.
Right. Ticker AIZ.
Exactly, AIZ. And we want to extract a purely data-forward, highly actionable analysis of where this stock currently stands.
Because it's an interesting one, right?
Oh, it really is. I mean, in the second quarter of 2026, while the whole broader market was distracted by the usual, macroeconomic hand-wringing and the latest speculative tech valuation.
Right, the AI hype cycle.
Yeah, exactly. While all that was happening, this quiet, highly institutional company managed to generate a staggering 19% jump in adjusted earnings per share.
19%?
Yeah, 19%. And they didn't do it by launching some new generative AI product or a revolutionary consumer app.
No, definitely not.
No, they did it by capitalizing on broken smartphones, reverse logistics, and lapsed mortgage insurance policies.
The boring stuff.
The deeply boring stuff. I kind of view Assurant as a financial shock absorber.
That's a good way to put it.
Like, it's not the sexiest part of a car, but it's the exact piece of machinery that ensures a smooth ride over economic potholes.
Yeah, absolutely.
So my challenge to you today is take these Q2 numbers and prove to us whether Assurant is genuinely building an impenetrable moat or if they're just, riding a temporary wave of favorable weather and lucky accounting.
Well, I will gladly take that challenge because the data we are parsing today really paints a picture of a company heavily insulated from the cyclical shocks that are kind of devastating traditional property and casualty insurers right now.
Yeah, it's rough out there for the traditional P&C guys.
It's brutal, but when you actually strip away the top-level corporate framing here and look at the raw mechanics of their revenue streams,
right,
particularly the B2B2C integrations they've secured with major telecom carriers and mortgage servicers, you see aggressive compounded growth happening in what most of Wall Street just dismisses as a mature, unexciting sector.
Okay, well, let's dive straight into the headline numbers then, because a 19% EPS jump for a company with Assurant's profile is, it's highly anomalous.
It is. It's a massive beat.
Yeah, a beat like that implies some serious operational leverage. So let's look at what they actually delivered in Q2.
Sure.
And specifically, let's focus on the adjusted metrics that exclude their reportable catastrophe exposure, just to keep it clean.
Right. Well, the primary takeaway from the quarter is that Assurant delivered its second consecutive quarter of record earnings.
Wow, second consecutive.
Yeah. So we are looking at an adjusted EBITDA increase of 18% and that adjusted EPS growth of 19% you mentioned.
That's just wild for a mature insurance-adjacent company.
It is. And when we zoom out to look at the first half of 2026 in totality, they've generated 12% adjusted EBITDA growth.
So it's not just a one-quarter fluke.
Exactly. For a large cap holding company, hitting nearly 20% EPS growth without relying on a massive singular M&A event,
right,
or like a wild swing in underlying asset valuations, it points to a very intensely optimized run rate business.
Yeah, I mean, those top-line beats are great, but my immediate skepticism as an investor always goes to capital allocation.
Oh, sure. Always.
Because generating record free cash flow is only half the equation, right?
Right. You got to see what they do with it.
Exactly. The other half is what management actually decides to do with all that cash.
And we've all seen companies mess that part up.
Oh, all the time. We see so many mature companies hit a cyclical peak and immediately squander that cash on, empire building or terrible overpriced acquisitions.
Just to mask slowing organic growth.
Exactly.
Yeah.
So let's look at how Assurant is handling capital return, because the transcript highlights some very aggressive moves in the quarter on that front.
They were very aggressive. The capital return metrics are arguably the strongest signal of internal confidence in this entire earnings print.
Okay, break the numbers down for us.
So in the second quarter alone, Assurant returned $123 million to shareholders.
$123 million in a single quarter.
Yes.
Yeah.
And we can break that down into $75 million allocated to open market share repurchases.
Okay.
And $48 million paid out in common dividends.
Right.
And they didn't pause at the end of June either. The transcript specifically notes that by July 31st, they had already executed an additional $30 million in share repurchases.
Wait, another 30 million just in July?
Just in July.
So that velocity of buybacks is telling, returning 123 million in a 90-day window, followed instantly by another 30 million the next month.
Yeah, it's a statement.
It suggests a management team that believes their equity is deeply mispriced relative to their forward cash generation.
Exactly.
But I do want to push back on the inherent bullishness of buybacks for a moment here.
Okay, let's hear it.
Well, when a company is sitting on the kind of cash Assurant generates, aggressively buying back stock can sometimes be a red flag.
A red flag that they lack vision.
Right, that they lack the vision to reinvest that capital into new high-growth verticals.
I see where you're going.
Yeah, I want to know if they are buying back stock because it's a great value, or if they are buying back stock because they've just run out of ideas for the core business.
It's a fair critique of buybacks in general, absolutely.
Right.
But the operational data from their core divisions heavily refutes the idea that they are starved for organic growth opportunities.
Okay, how so?
Well, to understand the buybacks, we have to look at the holding company liquidity first, which currently sits at $911 million.
$911 million. That's almost $1 billion in pure cash.
Exactly. They are maintaining nearly $1 billion in pure cash flexibility at the corporate level.
Wow.
So they have the dry powder to execute strategic M&A if a viable target presents itself. They aren't hurting for cash.
Right.
But in the current interest rate environment, maintaining a highly disciplined ROIC hurdle rate is crucial.
Return on invested capital for our listeners.
Right, return on invested capital. The CEO and CFO are clearly signaling that the highest yield, lowest risk asset available to them right now is their own stock.
Because they know the underlying metrics of their own business better than anyone else's.
Precisely. Particularly when you factor in the margin expansion happening in their actual operating segments.
Well, let's get into those operating segments then.
Let's do it.
Because the holding company liquidity, that's just a reservoir. We need to look at the actual cash engines filling that reservoir.
Right.
The company essentially operates in two massive divisions, right? Global Lifestyle and Global Housing.
Correct.
So let's start with Lifestyle, because the growth metrics here were the ones that really jumps off the page for me during the call.
Yeah, they were very strong.
They reported adjusted EBITDA up 21%, which is a $43 million year-over-year increase.
Yep.
I mean, for a division focused heavily on mobile device protection and extended service contracts, a 21% jump is massive.
It is. The Global Lifestyle division is undeniably the standout performer this quarter.
Wow.
The growth is heavily concentrated in a segment they categorize as connected living.
Connected living. Got it.
Inside that specific segment, EBITDA jumped 29%.
Wait, 29%.
29%. Now, we have to keep the analysis clean here.
Right. No funny business.
So we need to note that this 29% figure includes a $10 million one-time benefit.
Ah, okay. What was the benefit?
It was related to a client adjustment in their extended service contracts, combined with a bit of an international tax benefit.
Okay, so it's a bit inflated.
Yes, but even when we strip out that $10 million to find the true normalized run rate, we are still looking at 22% organic growth in connected living.
22% organic growth on a multi-billion-dollar revenue base. That's still incredible.
Exactly.
So the immediate question for me is what the underlying mechanism driving that growth actually looks like on the ground.
Right. What are they actually doing?
Exactly. A lot of retail investors hear device protection, and they think of, a static insurance policy.
Like a warranty you buy at Best Buy and forget about.
Yeah, exactly. But the Assurant model seems far more operational. The transcript notes, they serviced over 7 million devices in Q2 alone.
7 million.
Which is up 1.8 million devices year over year. That's a lot of phones.
It's a massive amount of phones. And that 7 million figure is really the key to understanding their moat here.
Break that down for us.
So Assurant is not just underwriting the financial risk of your broken smartphone.
Okay.
They are actively operating the physical global reverse logistics supply chain for the major telecom carriers.
Reverse logistics.
Right.
So when a phone goes back.
Exactly. When you upgrade your phone or you file a claim for a shattered screen, you are interacting with Assurant's invisible infrastructure.
So the carrier doesn't handle that?
Mostly no. Assurant handles the intake, the data wiping, the triage, the component harvesting, the physical repair, the refurbishment, and the ultimate redistribution of those devices into secondary markets.
So they're literally the ones doing the micro-soldering, the screen replacements, on an industrial scale.
On a massive global scale. Yeah.
I want to linger on the sheer complexity of that logistics network because I really think the market severely underprices how difficult that is to build.
It's incredibly capital intensive to set up.
Right. Think about the major telecom carriers, your T-Mobiles of the world.
Right.
They are phenomenal at spectrum allocation, marketing, billing, and network infrastructure.
Sure.
But they have absolutely zero desire to run warehouses filled with tens of thousands of broken iPhones requiring secondary market remarketing.
No, that's a logistical nightmare for them.
So Assurant has positioned itself as the indispensable back end to those carriers.
Exactly.
And because they control the physical repair and the secondary market disposition, they can control their own loss costs far better than a company that just cuts a check for a replacement device.
That control over loss severity is exactly why their margins are expanding right now.
That makes total sense.
By keeping the refurbishment in-house, they turn a massive cost center into a highly optimized logistical pipeline.
Wow.
And their scale is accelerating. Alongside servicing those 7 million devices, they added over 4 million device protection subscribers globally over the past year.
4 million new subscribers in 1 year.
Yep, net new.
The subscriber growth is fascinating given the current consumer environment, honestly.
How so?
Well, devices are getting more expensive, upgrade cycles are lengthening, inflation is squeezing wallets, and yet Assurant is adding 4 million net new subscribers.
Right. You'd think people would cut the insurance first.
Exactly. It really speaks to the stickiness of this B2B2C model.
B2B2C being business to consumer.
Right. They aren't spending billions on direct-to-consumer marketing. The point of sale is completely integrated into the carrier's ecosystem.
It's seamless.
Yeah, you go in, you buy a $1,000 phone. The carrier rep says, hey, want to add the $15 monthly protection plan to your bill?
And most people just say yes.
They say yes, and Assurant quietly captures that recurring fee-based revenue stream. It is a highly defensive posture for an environment where consumer discretionary spending might be tightening.
It's defensive because the psychological friction of canceling a device protection plan on a device you use 6 hours a day is incredibly high.
Oh, for sure. You drop that phone once without a case and you panic.
Exactly. Especially when that device represents a massive sunk cost to the consumer.
Right.
So Assurant captures the premium, they manage the logistics, and they leverage their massive scale to drive down the per unit repair costs.
That dynamic right there is what produces the 22% organic growth in connected living.
Precisely. It's a very well-oiled machine.
Okay, well, let's pivot from the tech in our pockets to the roofs over our heads, because the other massive engine here is global housing.
Yes, the housing division.
And the numbers here are just as robust, but the underlying mechanics are entirely different.
Completely different.
The transcript shows global housing hit an adjusted EBITDA of $275 million, which included $12 million in reportable catastrophes.
Right.
So excluding those cats, we were looking at an 18% jump to $287 million.
That's right. The margin expansion in global housing is driven by two distinct, highly favorable variables converging in this specific quarter.
Okay, what's the first variable?
The first is a very low non-catastrophe loss ratio, which came in at approximately 35%.
35%.
Yeah. We are seeing reduced claims frequencies across their housing book, driven primarily by an absence of severe localized weather events during the Q2 window compared to historical averages.
Okay, I look at a 35% non-cat loss ratio, and I see a company that is retaining a massive portion of its collected premiums.
Right, they're keeping the cash.
But we have to acknowledge the volatility inherent in that metric, don't we?
We do.
I mean, a quiet Q2 weather pattern is great for the current quarter's earnings, but it isn't necessarily a structural advantage they can bank on indefinitely.
No, not at all.
Weather normalizes over time.
Yeah.
You can't just predict good weather forever.
It definitely normalizes, which is why the second factor driving their housing margins is much more structural and, frankly, much more permanent.
Okay, I'm listening. What's the permanent factor?
Assurant successfully renegotiated their catastrophe reinsurance program, and they locked in new rates on April 1st.
Okay.
They secured significantly more favorable pricing and terms than they had in previous years.
Now, that April 1st renewal date is critical, especially for a company with heavy exposure to the Southeast and Florida markets.
Very critical.
Because over the past few years, we've seen the global reinsurance market harden dramatically.
Yeah, it's been a tough market for primary insurers.
Reinsurers were getting absolutely battered by secondary perils and massive named storms.
Right.
So they hiked their rates and raised attachment points across the board. They basically forced primary insurers, like Assurant, to retain more risk and pay higher premiums just for their catastrophic backstops.
Exactly.
So the fact that Assurant navigated these April 1st renewals with favorable pricing indicates that the reinsurance market actually views their underlying portfolio as highly disciplined.
That's exactly how you should read it. The reinsurers trust Assurant's book of business.
Yeah.
And by lowering their reinsurance costs, they fundamentally change the margin profile of every premium dollar they collect in the housing division going forward.
Less money flowing out to global reinsurers.
Exactly. Less outflow means more retained earnings dropping straight to the bottom line, regardless of whether the day-to-day weather patterns are mild or severe.
That's a huge structural win.
It is.
But the core revenue driver of the housing division isn't just standard homeowners insurance, right? It's lender-placed insurance.
Yes, LPI.
The transcript notes their tracked loans grew by 9%, hitting 34 million loans.
34 million.
I want to spend a significant amount of time breaking down this specific business model because lender-placed insurance, or LPI, is arguably one of the most misunderstood segments in the entire financial sector.
It really is. It is entirely unique.
So how does it actually work?
Well, Assurant operates as the dominant player in a market that exists purely to protect the collateral of mortgage servicers.
Okay.
The mechanics are pretty straightforward, but they are massive in scale.
Right.
When a consumer takes out a mortgage, the lender obviously mandates that the property must be insured.
Of course. You have to have home insurance.
Right. But if that homeowner allows their voluntary insurance policy to lapse, whether they just forget to pay, face some sort of financial distress, or get dropped by their carrier due to changing risk models in their state.
Which is happening a lot in places like California and Florida.
Exactly. If that happens, the mortgage servicer is suddenly exposed to total loss of their collateral if the house burns down.
And the servicer cannot allow that asset to remain uninsured for even a single day.
No, absolutely not.
Their fiduciary duty to the RMBS trusts demands continuous coverage.
Precisely why they partner with Assurant.
Ah, okay.
Assurant integrates its tracking software directly into the mortgage servicer's back-end systems.
So they are plugged right into the bank's data.
Yes. They are currently monitoring those 34 million individual mortgages actively.
That's a massive amount of data.
It is. And the moment their system flags a lapse in a homeowner's voluntary coverage, Assurant automatically generates a lender-placed insurance policy on that property to protect the servicer's interests.
Automatically. No human intervention needed.
Exactly. The moat here is entirely data-driven.
I can see that. The sheer volume of EDI feeds, the integration with local property tax records, the communication protocols with thousands of primary insurance carriers just to verify coverage.
It's insane.
It is an infrastructural nightmare to build from scratch.
You couldn't just start a company and do this tomorrow.
Right. That's why the major banks and non-bank servicers all consolidate around a massive player like Assurant. But this actually brings me to a specific data point in the Q2 transcript that I view as a potential red flag, and I want to see if you can justify it for me.
Okay, lay it on me.
The placement rate, meaning the actual percentage of those 34 million tracked loans that ultimately require Assurant to place a policy, dropped sequentially in Q2 down to 2.02%.
Yes, it did.
Now, in a high interest rate environment where household balance sheets are supposedly getting tighter, you'd naturally expect the placement rate to tick up as more homeowners struggle with premiums.
That's the logical assumption.
So a sequential drop makes me wonder if Assurant is losing market share or if the fundamental dynamics of the LPI market are just shifting away from them.
A sequential decline in a core KPI always warrants scrutiny, so you are right to point it out.
Thanks.
But the transcript provides a very clear, highly mechanical explanation for this drop.
Okay, what's the explanation?
It is not indicative of a macro shift in consumer behavior, nor is it a loss of market share to a competitor. No. The CFO explicitly stated that this drop was caused by a single specific client executing a portfolio rotation.
A portfolio rotation.
Oh, yes. One of Assurant's clients decided to transfer a block of their mortgage loan portfolio to a completely different loan servicer, and that new servicer operates outside of Assurant's ecosystem.
Okay, so a chunk of loans just vanished from the denominator.
Basically. But the critical nuance here is the specific profile of that transferred block.
What do you mean?
That particular subset of loans that was transferred carried a significantly higher than average placement rate.
Oh, I see.
Yeah, so when you mathematically extract a high placement block from the total pool of 34 million loans, the average placement rate for the remaining portfolio artificially deflates down to that 2.02%.
So Assurant didn't lose the underlying capability or get beat by a competitor. The client merely shifted a specific high-risk asset class to a different servicer.
Exactly. It's just a math quirk based on that one client's move.
Okay, I understand the denominator effect there, and it definitely makes the 2.02% less alarming.
Right.
However, losing any block of loans, regardless of the reason, is still a net negative for top-line revenue, isn't it?
Technically, yes.
You can't just brush off the loss of high placement loans as a mathematical quirk. It's lost revenue.
You don't have to brush it off because the loss of that single block is completely eclipsed by the massive acquisition they announced in the exact same division.
Ah, right.
Assurant finalized a new partnership with Freedom Mortgage.
Freedom Mortgage, okay.
Yeah, which is a top 10 U.S. mortgage servicer.
Wow, top 10.
Yes. And this deal is going to bring approximately 2.6 million new loans onto Assurant's tracking platform.
2.6 million new loans. Boarding that many loans from a top 10 servicer is a massive logistical undertaking.
It is.
The sheer data migration alone has to take months.
It does. Management noted that these new Freedom Mortgage loans will ramp up over the next 12 months.
Okay, so it's a gradual onboard.
Right. So whatever minimal revenue headwind they experience from that single client's portfolio rotation will be completely dwarfed as the Freedom Mortgage loans become fully integrated and start generating placement premiums.
That makes sense.
It solidifies their absolute dominance in the LPI tracking space.
This really highlights the importance of reading the full transcript and not just reacting to a top-line KPI algorithmic readout.
Absolutely. The algorithms just see the drop and panic.
Right. The placement rate drop is just a localized artifact. The Freedom Mortgage deal is a massive structural expansion.
Exactly.
And speaking of structural expansion, I want to touch on the geographical footprint of their operations.
Oh, yeah. The new facilities.
Right. We discussed reverse logistics in the lifestyle division earlier, but the transcript specifically mentions heavy capital expenditure, expanding their physical facilities in Nashville, Tennessee, and multiple centers in Texas.
Yes, they did.
For a retail investor evaluating the long-term resilience of a company, why should we care about where they're physically repairing iPhones? I mean, who cares if it's in Tennessee or Taiwan?
You should care because the geographic location of these facilities is a massive strategic advantage in the current geopolitical climate.
Okay, unpack that.
Over the past 5 years, we've seen the catastrophic vulnerabilities of relying entirely on overseas supply chains.
Oh yeah, the pandemic really exposed that.
Big time. If your entire reverse logistics apparatus is based in Asia, you are highly exposed to shipping bottlenecks, international tariff fluctuations, and just general geopolitical shocks.
Right.
By aggressively expanding their device care centers in Nashville and Texas, Assurant is effectively onshoring a massive portion of the global tech supply chain.
So they are actively insulating themselves from international logistical friction.
Completely.
If there's a global shipping freeze or a sudden spike in ocean freight costs, Assurant can just continue processing millions of devices right in the middle of the United States.
Without missing a beat.
And Nashville and Texas offer central distribution nodes, favorable labor markets, and massive square footage for expansion.
Exactly. And they explicitly noted in the call that they have significant capacity in these facilities to absorb future volume growth.
So they aren't maxed out yet.
Not even close. They aren't going to hit a physical bottleneck anytime soon. They've built domestic infrastructure that allows them to scale their reverse logistics operations without being beholden to the volatility of international freight.
So if we synthesize everything we've looked at so far, the operational realities are incredibly robust.
Very much so.
We have connected living growing organically at 22%, backed by onshored, highly scalable logistics.
Right.
We have global housing expanding margins through favorable reinsurance, tracking 34 million mortgages, and onboarding a top 10 servicer.
It's a great setup.
Given these core engines are running at this capacity, how is management framing the rest of the year? Let's analyze the forward guidance they provided for the back half of 2026.
Management is telegraphing supreme confidence.
Supreme confidence. I like the sound of that.
They used this Q2 call to officially increase their full year 2026 financial outlook.
They raised guidance.
They did. They are now projecting roughly 10% underlying growth in both adjusted EBITDA and adjusted EPS for the full year.
Yeah.
And to maintain parity with our earlier analysis, that 10% figure excludes catastrophes and prior year reserve development.
Oh, the clean number.
It is a pure reflection of their core operational momentum.
A 10% raise in guidance for a company of this scale, deeply embedded in mature markets, is a very strong signal.
It's highly unusual in a good way.
And did they break down the expectations between the two main divisions?
They did. The Global Lifestyle division is projected to be the primary alpha generator.
Ah, the smartphones again?
Yeah. Management upgraded the outlook for Lifestyle to low double-digit growth, which they attribute directly to the continued momentum in the mobile and device protection segments we analyzed earlier.
But the forward guidance on capital deployment is where the thesis really crystallizes for the retail investor, in my opinion.
The buybacks.
Exactly. We discussed the $123 million they returned in Q2, but their projections for the full year are even more aggressive.
Very aggressive. Management explicitly stated that they expect total share repurchases for 2026 to hit the absolute upper limit of their previously stated target range.
And what was that range?
It was $300 to $350 million.
So they're aiming for the full $350 million.
Exactly.
This circles back perfectly to our earlier debate about capital allocation and holding company liquidity.
It really does.
When a management team commits to the absolute ceiling of a massive buyback authorization while sitting on $911 million in cash, they are sending a definitive message to Wall Street.
Absolutely.
They are actively rejecting the temptation to engage in reckless top-line vanity M&A.
Which is so refreshing to see.
It is. They have evaluated the entire competitive landscape, looked at the underlying cash generation of their B2B2C contracts, and concluded that aggressively retiring their own float is the most accretive move they can make for long-term shareholders.
It demonstrates a level of capital discipline that is exceedingly rare these days.
Yeah, they aren't hoarding cash out of fear, but they aren't deploying it recklessly either.
Right. And the historical context provided during the Q&A portion of the call adds significant weight to this strategy.
What did they say in the Q&A?
The CEO pointed out that 2026 is projected to be Assurant's 10th consecutive year of profitable growth.
Wow, a full decade of uninterrupted profitable growth across multiple macroeconomic cycles.
Yeah.
I mean, that covers rate hikes, inflation spikes, a pandemic, and massive shifts in consumer spending.
All of it. And one of the analysts actually pressed management on whether this current Q2 performance was just the peak of a cycle.
Like, are we at the top?
Right, like a harvesting of past momentum.
Right.
But the CEO's response was highly illuminating.
What was his response?
He detailed how the massive EPS and EBITDA numbers they are printing right now in 2026 are the direct, delayed result of heavy capital expenditures they made back in 2024 and 2025.
This is the CapEx cycle playing out in real time.
Exactly.
The expansion of those Nashville and Texas reverse logistics facilities, the integration of new AI-driven triage capabilities in their claims processing, the upfront costs of deepening their API integrations with telecom partners.
Yes.
Those were massive cash outlays 2 years ago.
Exactly. Those investments are no longer dragging on the balance sheet.
They've turned a corner.
Right. They have matured, they're actively scaling, and they are yielding the 20% EPS jumps we are seeing today.
That's a great narrative.
Management is heavily signaling that this is a perpetual motion machine of cash flow.
Invest, scale, harvest.
Invest heavily during periods of strength, optimize the infrastructure, and reap the margin expansion years later.
Right.
And they confirm they are continuing to deploy strategic CapEx today to ensure 2027 and beyond maintain this exact same trajectory.
Well, the narrative is compelling. But for the listener who is currently holding AIZ in their portfolio, or perhaps evaluating it for a new position, we need to synthesize all of this data into a definitive verdict.
The bottom line.
Exactly.
Yeah.
The headline beats are undeniable. The operational dominance in LPI and reverse logistics is clear. The management guidance is highly optimistic.
Right.
But what is the overarching thesis that makes Assurant a compelling hold in the current 2026 macro environment? Where do you ultimately stand on the stock?
I maintain a definitively bullish stance on Assurant for the retail investor.
Definitively bullish. Okay, give us the core rationale.
The core rationale boils down to their structural resilience against macroeconomic degradation.
Okay.
We are operating in an environment right now where inflation, supply chain constraints, and cyclical downturns are terrifying the broader market.
Oh, absolutely.
Traditional property and casualty insurers, your standard home and auto carriers are getting absolutely decimated by these forces.
Because the traditional P&C model is inherently vulnerable to inflation.
Very vulnerable.
I mean, think about it. If a carrier collects a $1,500 premium today based on current risk models,
Right.
but a major storm hits 8 months from now, and the cost of lumber, roofing materials, and labor has spiked 30% due to inflation.
The premium doesn't cover the repair.
Exactly. That static $1,500 premium suddenly doesn't cover the cost to rebuild. Their loss severity explodes, their combined ratios breach 100, and their profit margins evaporate.
We've seen it across the entire sector this year.
We really have. So how is Assurant different?
Assurant is structurally insulated from that exact dynamic.
How so?
The most vital yet easily overlooked piece of the entire earnings transcript was the CEO's explanation of Assurant's automatic inflation guard mechanisms.
I really want you to break down the mechanics of this inflation guard, because I feel like this is the absolute crux of the bull thesis.
It absolutely is.
How does a company inherently exposed to housing and device repair automatically hedge against inflation?
It is brilliant in its mechanical simplicity. In their global housing division, the amount of premium they charge for a policy is not a static number.
It's not static.
No, it is dynamically tied to the insured value of the underlying property.
Ah,
During the call, management noted that their average insured housing values are up 5% year over year.
right, because as national real estate values and replacement costs rise due to inflation, the baseline value of the homes they're insuring naturally increases.
Correct. And because their premium algorithms are pegged to that insured value, the premium Assurant automatically collects also increases by a corresponding amount.
That is incredibly smart.
Inflation actually functions as a top-line revenue driver for them.
Wow.
It automatically scales their premium intake to match the rising costs of potential future claims.
So they don't have to go to a state regulatory board and fight for a massive, highly publicized rate hike the way traditional carriers do.
No, they avoid that entire regulatory nightmare. The inflation guard captures the necessary premium seamlessly, maintaining their margins without introducing customer friction.
It is quite literally a self-correcting financial mechanism.
Exactly.
That dynamic alone separates them entirely from the traditional P&C cohort.
Totally.
While standard carriers are bleeding cash to supply chain inflation, Assurant's revenue mathematically expands to absorb the shock.
It's a huge competitive advantage.
And I will add my own synthesis to this bullish view, which centers on the sheer stickiness of their B2B2C distribution model.
Yeah, let's talk about the stickiness.
We've talked about T-Mobile and Freedom Mortgage, but the transcript also highlights their Cover 360 platform in the renter's insurance space.
Right, Cover 360.
They announced they are now fully integrated and serving 7 of the top 10 property management companies in the United States.
The scale of capturing 7 of the top 10 PMCs cannot be overstated.
It's massive.
Huh.
Think about the frictionless nature of that customer acquisition.
Yeah.
When a consumer rents an apartment from one of these massive property management conglomerates, the leasing agent mandates that the tenant must secure renter's insurance before they are handed the keys.
Right, it's mandatory.
And the tenant doesn't want to spend 3 hours shopping for quotes online.
No one wants to do that.
Seamlessly, right there inside the digital leasing portal, they are offered a policy powered entirely by Assurant's Cover 360 platform.
Just one click away.
Exactly. The tenant clicks accept. Because it's immediate and integrated, the premium is often just rolled into the monthly rent payment, and Assurant instantly locks in another recurring revenue stream with essentially zero direct marketing cost.
It creates an infrastructural moat that is nearly impossible for a disruptive startup to breach.
You couldn't just build an app and steal that business.
No, you cannot just launch a slick direct-to-consumer insurance app and expect to displace Assurant from the core operational leasing software of the largest property management companies in the country.
Right.
You can't just rip them out of T-Mobile's global supply chain or Freedom Mortgage's EDI feeds. They are entrenched at the institutional level.
Which brings us back to the core appeal for the retail investor navigating all this macroeconomic uncertainty right now.
Cash flow.
Assurant generates durable, recurring, fee-based revenue driven by contractual obligation.
Yeah.
Whether the S&P 500 is hitting all-time highs or grinding through a bear market correction, consumers are still paying their monthly smartphone bills.
Which include embedded device protection.
They're still paying their rent, which includes embedded Cover 360 policies.
Right.
And if they default on their voluntary homeowners insurance, the lender-placed insurance automatically kicks in. It is an incredibly resilient cash flow model.
And that resilience is precisely why producing 19% adjusted EPS growth in a single quarter is not an anomaly.
It's the norm.
It is the expected mathematical output of a highly optimized, heavily insulated machine operating at peak efficiency.
Beautifully said.
When management projects a 10th consecutive year of profitable growth, the granular data we've analyzed today completely validates that confidence.
So for you, the Talk Tickers listener, let's distill this deep dive into the rapid-fire takeaways you need for your portfolio analysis of Assurant's Q2 2026 earnings.
So let's hear them.
Number 1, they delivered a massive double-digit earnings beat, expanding adjusted EBITDA by 18% and EPS by nearly 20%, driven by a highly optimized reverse logistics supply chain and automated mortgage insurance tracking.
Check.
Number 2, they possess a fundamentally counter-cyclical business model featuring automatic inflation guard mechanisms that turn macroeconomic headwinds into top-line revenue growth.
A huge point.
Number 3, management officially raised their full-year financial guidance, projecting 10% underlying growth, heavily weighted toward low double-digit expansion in the global lifestyle division.
Very strong signal.
And number 4, armed with nearly $1 billion in holding company liquidity, they are aggressively buying back their own stock at the absolute upper end of their targets, signaling massive internal conviction regarding their intrinsic value.
It really serves as a masterclass in how a company can quietly execute on every operational metric while operating entirely beneath the radar of mainstream retail hype.
It really does. And that leads me to the final provocative thought I want to leave you with today.
All right, give it to us.
As you review the allocations in your own portfolio, consider this. If Assurant is printing this much free cash flow,